Hello Internet, welcome to Making Money. My name's Eric and this is your Daily Dollar, our financial segment where I give you one lesson every day to help you reach your financial goals. We got a big lesson today, and you know it's big because I got notes. And I don't normally have notes, but we got a lot of information to go over and I didn't want to miss anything. And these are unedited videos, so we got to do this in one shot. But it's big. We are going to be going over 12 types of investments. So there's a ton of information here. We've been talking about getting into investment. We've been talking about stocks in the stock market and things to think about when you start getting into investing. Today we're going to talk about 12 different things that you can invest in, types of ways that you can invest. And the first one is bonds. So when we talk about the stocks market and stocks, we tend to think, of investing as, stocks and bonds. That's something that comes up all the time. It tends to be, part of a well-rounded portfolio. But what are bonds? So bonds tend to be a safer alternative to stocks, and they are issued by government agencies and corporations, and basically what they are they're a loan. You are loaning money to that entity, and they agree to pay you at a set point in the future with interest. And that's what it is. They tend to be, again, a little less risky, but they also tend to have a lower return rate to them, normally around 2 to 3% per year. Bond rates right now are actually a little bit lower than that, a little under 2%, depending, again, if you're doing a 5, 10, 15, 30-year bond. But that's what a bond is. The next is an annuity. Annuities are also low-risk investments. They're also contracts. They require either a one-time or ongoing payments and pay specified sums to the investor at points in the future. Now, an investor can aim to receive more in payments than they put into the annuity, and that's how they would make money. So if you are, let's say you put a lump sum in now, and the annuity says that you'll get paid X amount every month until you die. You're aiming to get more paid back than you put in originally, and that's how annuities work. And because of that, annuities tend to be a big part of retirement planning. We tend to hear them more talked about in retirement because those kind of payment structures. The next is real estate. So these tend to be a little bit more risky. Real estate can be risky because home prices on rentals and houses, they are subject to change. I mean, back in 2018, we had the housing crisis. And recently, prices for houses have gone through the roof. Is coming back down a little bit now, but it varies over time. So because of that variability, there is a little bit more risk to real estate. Now, that being said, when you buy real estate, it's not normally the house that you live in that we're talking about. We're more talking about buying property or buying rental property. So the good thing about rental property is that you can make money from your tenants. You have income coming in while there's someone living there. The downside is that you tend to have to manage that property and maintain it, and that costs money. Buying property or buying land, you have to pay taxes on that property. So there's also fees associated with that there. The big thing with real estate is that you tend to want to buy for one price now and aim to sell at a higher price in the future. And that's real estate, in and out, very simple. The next one we have is commodities. So you don't really think of commodities when you think of investing too much. Maybe because commodities are so connected to investing, we might think, oh, commodities, yeah, I've heard that before. But commodities tend to be stuff like wheat and corn and crude oil. And you don't think about investing as an individual. You think of something like, oh, that's something an institution or a company does. But you, as an investor, can indeed invest in commodities. Basically, what you're doing is you're predicting the price of that commodity in the future. And these tend to be done, again, through contracts, futures contracts. And you agree to buy a commodity, so much of a commodity in the future for a set price. And if you do that and it's worth more when, the contract expires and you buy it at a lower price, you've made money on that commodity. Now, commodities tend to be a bit more complex though, because they're impacted by global supply and demand. So that adds a layer of variability to commodities. So they aren't as simple as they seem up front. I'm going to buy corn, hold it, and then sell it. But, the price of corn can fluctuate quite a bit. So commodities are definitely something you can get into investing. It's just not as common for a lot of people to do. The next one is a little bit more common, not so much when we think about investing per se, but it is something that a lot of people do, and this is collectibles. I do this. I'm currently collecting cards from my youth. So Pokemon cards, Yu-Gi-Oh cards, Magic cards, I tend to like to collect those type of things. But what it is you're basically predicting the value in the future, right? You're taking a look at something now and perceiving that it has value that it doesn't yet have. And basically what happens with collectibles is they will go up in value either due to, taste, let's say artwork. If, all of a sudden this type of artwork becomes very popular, its value will go up. Also, likewise, scarcity. Again, with the cards that I'm buying and selling right now, as we go on in time, they get damaged, they get lost, and they may have started out with a degree of rarity to begin with. So the rarer they get, the higher they go up in price. Collectibles tend to get grouped. Fine art gets grouped together, sports memorabilia, precious metals. Also, kind of a big thing these days, NFTs. If you're not familiar with what an NFT is, basically digital collectibles. And they're becoming a bit more mainstream. Love them or hate them, whatever you think of NFTs, they are considered collectibles. So they would fall under this type of investment. All right, the next one is currency. So I mentioned before that I don't like holding cash. Holding cash is not an investment, but currencies are. We'll kind of break that down a little bit. So we talked about how currencies, to be money, they have to have a measure of value, a medium of exchange, and a store of value. We also mentioned a few other things. But when you think of currencies, we tend to think of what we call fiat currencies. And these are currencies put out by governments. And that could be the USD, the US dollar, euro, yen, the rupee, anything. But the truth of the matter is that currencies have been around long before there were governments. Shells and rocks were at one point used as currency, and they did everything that money does for us today. Now, the way that you make money on currencies is through exchange. Currency value fluctuates over time, and you can make money by trading certain types of currency for other types of currency at given points in time. You can do this on the foreign exchange market, or Forex, if you've ever heard that before, but you can buy and sell currencies and make money off that. The next one is also kind of big these days, and that's crypto. And you'll notice that I didn't put crypto in with currencies. Even though it is cryptocurrency, there is some debate whether or not cryptocurrency is technically a currency. And you may have strong feelings about this. You may say, hell yes it is, or heck no it isn't. I would like to hear from you in the comments below. Is cryptocurrency an actual currency? Does it hit everything a currency is supposed to be? For the sake of this video, it is a form of investing. It definitely is. People have made a ton of money on crypto, so we're going to talk about it now. So cryptocurrency is fairly new. When we talk about cryptocurrency, a lot of people think of Bitcoin because Bitcoin was the first cryptocurrency, and that was created in 2009. So relatively new. But since then, countless others of cryptocurrency has been created, and those are called altcoins. And there are, coins Litecoin, Ethereum, Dogecoin, Shiba Inu, and basically much like a lot of the other types of investments we talk about, you can buy and sell crypto on cryptocurrency exchanges. Some retailers will even allow you to exchange crypto for goods, bringing another point to the is cryptocurrency a currency? We can buy things with it. I'm not going to put one way or the other, but I'm interested in hearing from you guys what you think. But yes, cryptocurrency, 100% an investment. So there you go. The next one is stocks. We talk about stocks a lot, and we're going to continue to talk about stocks a lot. And pretty much all the rest of the types of investment on this list have something to do with stocks. Stocks are among the most common types of investment. And basically what a stock is, you are buying a share in a company. You're buying partial ownership over that company. This also allows you as a stockholder to have some voting rights in that company. Now, this will depend on the type of stock that you buy. There are certain stocks that are excluded from voting rights. Now, those stocks were initially aimed to be cheaper so that you could buy cheaper stocks but not have the voting rights, and the more expensive stocks would have the voting rights. But that's not always true. In fact, Google's a great example of this. Google has A, B, and C stocks, but A and B have voting rights, C doesn't, I believe it is, but they're all basically the same price. So it may be important to you to have voting rights, it may not, but it is good to know that you can with certain stocks. Now, by buying and selling shares through a broker or a stock exchange, we can make money off of stocks. Now, stocks do tend to be a bit volatile, maybe not so much as crypto, though some cryptocurrencies are getting a little bit more stable over time, arguable. Stocks do tend to be variable, and that definitely depends on the company that you're investing in. But this rise and fall, while it introduces risk, it also introduces potential reward. So stocks, that's a big one. The next one is options. Now we're back to contracts again. So an option contract is just that, a contract that gives you the right to buy or sell a stock at a set price in a set point in the future. That's what it is. Though options offer you a bit of flexibility, because it doesn't obligate you to buy or sell the stocks in the future. You have the option to do so. That's where the name comes from. Most option contracts tend to be for groups of 100 shares. So we talked about in our leverage video the other day that technically options are a type of leveraged investing, because you are leveraging, more than the normal amount of shares. You're actually investing more or building contracts, writing contracts that affect more than just, one share of the company. Now, that being said, when we buy or sell an option, we have, again, options. We can either buy or sell the stock at the agreed upon price within the agreed upon time. So the contract says I can buy these stocks at this price before this date. I want to do that. I can go ahead and do that. We could decide to take that contract and sell it to another investor for a profit. You could also let the contract expire, go past that date, and once it does, it's basically worthless. But it's an option. So that's what options are. Mutual funds. Okay, so the next three are kind of grouped together. The next three are actually our last three. The first one is mutual funds. Mutual funds are an investing product. And they use stocks to earn money for a large group of investors. Basically what happens is a bunch of investors pool their money together, and a manager will manage the mutual fund. They will buy and sell an assortment of stocks, potentially daily, potentially hourly, and aim to make that group's investment make money, okay? That being said, because mutual funds are managed by someone or a group, they tend to cost money. There tends to be fees for that manager's expertise and efforts. Mutual funds will vary in their degree of risk based on how good that manager is, but a well-managed mutual fund can provide a high return at low risk, but probably for a decent fee. So something to keep in mind. All right, index funds. Index funds are a type of mutual fund, but they're passive and they track an index. An index is a subset of the market. So example, we have an S&P 500 index fund, and the point of this index fund is to mirror the performance of the S&P 500. And instead of buying every stock in the S&P 500, it buys targeted stocks, basically a subsample of the S&P 500 that will perform about the same as the S&P 500. Said S&P 500 a ton in that sentence. So by holding that index, you are aiming to track the performance of the initial index. They tend to cost less because, again, there's nobody managing them. It's passive. And the risks, well, they'll vary. Again, because it's tracking an index, my hand movements are weird here. because they're tracking an index, it'll be based on how the index does. So if you're tracking an index with high risk, then yeah, you'll have more risk. If you're tracking an index with lower risk, then yeah, you'll have lower risk. All right, we're on our last one. Number 12, exchange traded funds, ETFs. So an ETF is a type of index fund, which is a type of mutual fund. And ETFs track benchmark indexes. So these are a little bit more safer and consistent. And again, they aim to mirror the performance of these indexes. They also tend to be a bit cheaper because, again, they are not managed. So what makes them different? Why is an ETF different than an index fund? It comes down to how ETFs are purchased. You can buy and sell ETFs just like you would any other stock at any point in the day during the normal stock market days, Monday through Friday, excluding holidays. Anyways, you can buy it and it will go up and down in value just like a stock does throughout the day. Index funds and mutual funds, you can't buy throughout the day, well, at least not at a varying price. At the end of the market day each day at close, the index funds and mutual funds have a set price. And you can buy or sell a mutual fund or index fund at that set price. Now, in reality, this difference doesn't really matter to a lot of investors. They're still getting the same exposure. They still can buy into the index funds or ETFs or mutual funds. So their gains tend to be about the same depending on what they're buying. However, if you want more control over the price of your whatever you're buying, then ETFs may be the way to go. And that is 12 types of investments. That was a lot. Again, we're going to do videos on each and every one of these so you guys can dig a little deeper if there's anything that you want to learn more about. I hope you guys like this video. I hope you guys like this lesson. Super important to know the variety of investments and that you can get into. Yeah. If you're enjoying this series, feel free to subscribe. Always appreciate it and allows you guys to keep in contact with what the newest video and lesson is, which is good. I'm interested, like I mentioned before, is cryptocurrency a currency? Leave that in the comments. That's the word below. You can hit me up on Twitter, link in the description, and I will see you guys tomorrow for another video. All right, guys. See ya.